Well, hi everyone. This video is how to read a whale curve, and this basically is going to share some of the to be able to look at whale curves, to be able to understand what on a macro sense they're telling us, and to give you some insights into what you might do with the whale curve information you get. So I'm Randy MacLean. I'm the president of WayPoint Analytics and also the co-founder of the Advanced Profit Innovation Conference. And so let's look at the whale curves. First thing, what's a whale curve? Not everybody knows this. The whale curve is basically a way of charting a ranking report where you have the most positive thing on the top, the least positive thing on the bottom, and in the context of WayPoint and what we do with it, we would be looking at the profitability of a line item or the profitability of a customer or a particular SKU. And the way the whale curve works is we start with a blank curve down at the lower left-hand corner of the chart. Then we put the profit from the very most profitable item on it. Then we stack on top of that the additional profit we make on the second, third, fourth, fifth, sixth items, working all the way up the curve until we essentially run out of profitable items. In this case, customers, and by about 250 customers, we've made all the positive profit we're going to make. And then along the back of the whale here, we run into some customers where we lose $1 or $2, and then 4, and then 8, and so on until we get to the very bottom of the chart, and where we had the least profitable customer or the biggest money losing customer and has deducted from our pile of profit the last big chunk of profit that was available. So in about 800 customers here, we made about $1.3 million worth of profit, and it's sold, delivered, collected bottom line profit in the first 250 customers. And then we lost all of it, but about a little less than $400,000 in dysfunction or money losing customers along the rest of the whale. Now, the reason that this is really useful is it gives us a real good insight into the profit potential that's in the business. And these whale curves are a great indicator of how much money there is that you can capture if you go out and change a few things around. And ultimately, what you're going to want to do is raise the whale on the left-hand side by generating more profits where you can get them, and then reduce the downturn on the whale on the right-hand side by reducing the things that drain the profits away. So on the left side of the whale, we have the area where we generate the most profits. And so when we look at this and about the first 120, 130 customers, we're making almost all of the profit in the business. And so recognizing that even within this group of customers, we have money-making customers, we may have money-losing sales. Anything we can do to eliminate the money-losing sales within this pool is actually going to make the arch of the curve of the whale go even higher, and it's going to generate more profit for the bottom line. So it's always good to be looking for profits, even in places, or especially in places where we already have them. Along the top of the whale, these are the middle of the ranking list, and this is where we're trading dollars. We have some usually low volume accounts where we make or lose a few dollars, and big gargantuan efforts here are not going to provide big differentials in the results, and so they're not high on our priority list. But the one thing that is interesting is that these smaller accounts that generate small amounts of revenue and may win or lose us a few dollars are a great place to apply policy solutions that can change the trajectory or the slope of the back of the curve of the whale, and you'll see some more examples of that in future slides. Along the right-hand side, we have the biggest money-losing accounts, and these are the accounts that are really draining the profits away. It's almost always the case that we have accounts here that probably make okay margins, and gross margin isn't really the issue. What it really causes the losses most commonly is high transaction counts, that basically are indicators of a greater consumption of our resources. And so it's a great opportunity to close off those losses. And the real takeaway here is if we can do some work over here, we can retain some of the profits we've already made. And so what that leads us to is a conclusion that says we don't have to go out and find magical new customers to deliver magical new profits in order to get the business up. All we really have to do is work within the business we already have to reduce the losses that we're taking in that area, and we can make large improvements in profitability. Now, I've been told that, I'm so used to working in an environment where people get 50%, 100%, and 200% increases in profit that it now seems normal to me. And a little while ago, somebody kind of reminded me that to other people that may sound like rainbows and unicorns, but I assure you this really is real. These profits exist in every business, and if you just take the time or get the facilities to be able to identify them and then do something about them, there's a lot of profit to be had within the business you already are doing. So when we look at this green area under the curve, what we really have, this is basically the bulk of the lost profits that are happening in this particular business scenario. Because it's profit that was made and then lost, and as you can see, it's pretty significant. In fact, it's the bulk of what the company has done, the bulk of what it's won, it's lost back into the market space. Now, here's some other things that we can draw from looking at the whale curves. First of all, when we see a whale curve that looks like a parabolic arc or maybe a bell-shaped curve, what that generally tells us is the costing model that's underlying the whale curve is a little bit too general. What we really want to do when we're doing a good job of costing is make sure that we're isolating different cost pools and marrying them to different transaction pools closely enough that we can see places where we make more money or less money because we're more or less efficient in those places. And where we have models that are just a little bit too general, we just take one big number and sort of peanut butter across everything. Or when we tie the cost more to the production measures of the company, we're going to wind up with a curve that looks like this. Now, it still doesn't, there's still lots of profits to be had, and all the things that we would want to do in terms of increasing the gross profit and reducing the transaction counts will be good and will accrue to the benefit of the company. But ultimately, we lose our ability to better focus on the things that are really going to produce a real important result if we don't have a more specific model. Okay, this is a more normal curve. This is the kind of thing that we would normally see, and you can start to see the whale taking shape. There's a little bit of a different trajectory, and along the broad back of the whale, we can see an ever-increasing amount of profits being lost. In this kind of model here, where we're seeing a fairly gentle curve over on the left and then another long curve to the right, this means that we probably have more of a systemic issue with profitability. We have policies or procedures that generally lose money on most of what we do, and it curtails the profits on the best part of the business because of what we're doing. So when we see a gentle curve like this, what we really would expect is that we're going to be looking for policy type solutions that'll help straighten out the profitability issues, or at least will be one of the first places we can attack on profitability issues. Now, here's a different kind of a curve, and there's two aspects of this curve. The first thing is that it has a fairly steep slope on the left side and a very steep slope on the right side with a long back on the whale. And what this curve is telling us is that we have a very narrow band of things that we do that contribute a lot of profitability to the business. And you can see it takes us up nearly to $8 million of profitability pretty quickly on a very narrow band, maybe 10% of what we do. And so that means we have an area that we can hyper focus on to do a superior job. There's some niches in here that we can really service well, and in fact are servicing well right now. We can take that to the next level and make them defensible. That's good for the business. Along the right-hand side, we have a very narrow band again that is siphoning a lot of profits off the business. And in fact, this business is underwater. Now, in this particular company, they have a couple of very, very large national accounts that are basically getting them to duplicate some of the logistics of the national account and providing lots and lots and lots of deliveries to lots of locations that are very small value. And that is really siphoning the profits out of the business. The business would be much better off if it gave up some of its volume and got rid of the drain here, because frankly the big customers that they have in this group, and there's only 3 of them, are siphoning off all of the profits of the business and then some. If they were gone, the volume of the business wouldn't be quite so high, but instead of losing $3 million a year, they'd be probably making somewhere on the order of $5 million a year. And that's an $8 million turnaround for having given up some volume and a lot of the activity that goes along with it. So when we see a curve like this means that there's a fairly narrow band of solutions that will make a big impact on the company and will have an effect on a very narrow group of customers or very narrow group of products. And so it's a great place to go and mind the business for profits and do a turnaround. This is the curve from a very, very sharp company. They've been following Merrifield's advice for much more than a decade, doing it back of the napkin, and then we're one of the first companies to figure out that WayPoint was an even better way of finding this information out and getting after it. And as you can see, almost everything they do makes money. In fact, they have almost no money losing customers, so everything that they do in the business accrues to more positive profit. And it's only a very narrow band of things that lose a few dollars, and then just a very few customers at the very tail end on the right-hand side that have any kind of significant losses at all. And this company is a cash cow, generates an enormous amount of income for the family that owns it, and is probably one of the best run businesses in the country. Now, we've been looking at whale curves by customers and so on, and I wanted to take a minute to differentiate the kinds of whale curves that you could be looking at and give you some idea of the various things that would be available to you in helping identify priorities for your business. And remember, what we're trying to do with a whale curve and with ranking reports and so on is to make sure that we're spending as much of our time as possible working on the things that are going to provide a significant return to the company, basically working on the right things. And so when we look at a whale curve by SKUs, in this business, we can see they have a pretty broad section of their line, probably about 1,000, 1,200 products that generate reasonably good income for them, good profit levels for this business. Then they have a very broad range, probably about 3,000 products, 3,000, 3,500 products that are just basically we trade dollars on, and then a very narrow band, probably about 200 products at the very bottom of the list that basically are involved in the bulk of the losses in the business. And those 200 products take the profitability from something around 12 million down to about 4 million. And so it's about an $8 million loss to support those last 200 products. When we see this kind of thing on the SKU curve, it gives us a very, very narrow area that we can focus like a laser and start to understand what the products are, what the issues are with them, who's buying them and why, and then we can start to come up with creative solutions. And so we can, instead of trying to focus across a 5,000 product line or a 4,700 product line, we only really have 200 that really need a lot of attention. And so we can zero in on those and use some of the other strategies and tactics that we talk about to change the game in that area. You can also have a whale curve for customers, and we referred to this before. Here's a company with about 2,300 accounts. They make about $8 million on the first 1,000 of them, and this is actually a reasonably good customer whale curve. This business makes money on up around 50% of all of their accounts. And this is a company that's been doing some of these things for a while. Most companies only make money on about a fifth or a quarter of their accounts, and so they've been working their way along and have basically increased their profits by more than 100% recently when they started working on these kinds of things. But still, there's a pretty steep downturn on the right, and there's a very narrow band of customers that they could work on that would add another $2 million to the bottom line without an awful lot of effort if they just do the things that need to be done. And so it'd be pretty nice to get a 50% profit increase in any business from one year to the next, and this is a business that's poised to do that. Okay, so in summary, you use the whale curves to evaluate the cost models in WayPoint, and that's that rounded curve so that you can check to make sure that the cost model that you're using is specific enough that you can get some good indicators of where the low-hanging fruit is or where you're going to get the biggest return. It's not to say that you have to perfect that before you get going. In fact, that's the last thing that you want to do because everything that we recommend will give you good results that'll translate into your financials anyway. But the main thing is as you're trying to take things to the next level, if things are a little bit too general, then you're going to have a harder time doing an accurate job of identifying the best opportunities. Second point is to use the peak internal profit whale curve. That's the whale curve where we show the profitability on each individual line item to identify your opportunities and to measure the progress. And so when I'm talking about measuring the opportunity, that is the one curve that will tell you how much real profit there is at a granular level flowing through your business right now. And you may find millions, or even in some cases tens or even hundreds of millions of dollars available to you that you could go after. And once you find out that there's really a pot of gold out there, that's the first step to getting it down the road to getting it. Next point is that you can use the SKU whale curve to prioritize product issues and look for opportunities in the product that are product related. These come down to operational issues, sometimes buying, sometimes bundling, kitting. There's all kinds of tactics you can use, and you can hear about those in our other videos. But it's a great place to find out where there's opportunities and what the range of opportunities there is for you in your product line, and that the operations people can work on. And then finally, and maybe most importantly, or most used certainly, the customer whale curve gives you a real good indication of what range of customers you can be working on or working with to put more profitability in your business, and just as importantly, more profitability in their business, because every time we do something that reduces our costs in terms of transactions, it also reduces their costs in terms of transactions and delivers them a profit benefit as well. So that was our discussion on whale curves for today. I wanted to thank you for spending some time looking at them with me. I hope you're better armed to be able to go out and do some of this research and learning within your own whale curves. And I do hope that you'll look at our other videos on other topics to learn what to do next. So have a great day. Thanks very much.
Hi, it's Randy MacLean. If you found this video helpful, we have so much more to share with you. Just head over to our website and sign up for our Innovative Profit Tips series. It's a great collection of materials all designed to show you how to drive more profit in your business without necessarily having to add new sales. Just head over to APIC, that's APIC, conference.com/profit, or simply text your name and email address to 480-207-3433 and we'll get you started right away.